Saw what happened on Wall Street on Friday. We continually see the Dow futures under pressure. Nikkei had its worst closing in 15 months, and in Europe, it's not looking much better either. German DAX on opening fell 100 points. Let's invite Nick Parsons, the founder and managing director of Simply Macro Strategy now. Hi, Nick. Good morning to you. What's your strategy? We're seeing the worst performance for the global equity markets in 2 years. Look at where the U.S. Treasury bonds are as well. How are you approaching these global stocks at the moment?
Well, good morning from London. I think the watchword here is caution, because although we've seen pullbacks that have been somewhere between 2 and 3% across most of the major indices, I think, are at risk of a more substantial pullback over the course of the next few weeks, simply because of the surprise factor. Investors didn't believe, they'd forgotten that equities could go down. As of Thursday of last week, it was the longest period in the history of the S&P 500 that we'd gone without a 5% pullback. And so investors really have forgotten that markets can come down. And I think we are going to see a much more cautious stance over the near term. It's not to say we're going to have a crash. I don't believe that. But I do think that the pace of gains is going to be substantially different. And we're going to see a lot of what we might call housekeeping in portfolios to try and be somewhat more defensive and protect them against downside volatility.
Right. Nick, talking about the concerns which are actually leading to this pullback, of course, the obvious one being the fears of interest rate hikes, and then in the UK and the US, we saw some sell-off happening after dismal set of numbers, quarterly earnings. Are there any more underlying concerns that one needs to keep an eye out for, apart from the obvious glaring ones?
Well, I think the two obvious ones that you've made are going to dominate sentiment. For the UK in particular, we've got an added uncertainty about politics and Brexit. We simply don't know what the UK government wants as its end position. So I think that the strength in this pound that we've seen over the course of January is going to be somewhat reversed. So I think we're going to see political uncertainty there. And of course, as we get towards March, we've also got elections coming up in Italy in the first week in March. And we mustn't forget that Germany still doesn't have a government. It's very likely that Angela Merkel will be the leader of a new big coalition, the so-called GroKo, which is what Germans call a big coalition. But if Angela Merkel comes as the head of a GroKo, but she's not allowed by her coalition partners to follow the sorts of policies that she has been doing over the last few years, if we get uncertainty around Italy and we simply do not know what the UK government wants from its own position post-Brexit, then I think the risks are that we see quite a lot of volatility in European markets and some of these major indices globally. So I would flag up political risk as well as the two more obvious ones around earning and rates that you alluded to.
Nick, this is Sid joining in conversation. Thank you for joining us. Nick, entire highlight of this bull run in US market was a weak dollar. Now, here in emerging markets, we try to assess, the fund flows by looking at what's happening in dollar, what's happening to some of the lead commodities like crude. And what we have established here that the weak dollar and a strong crude is helping, global markets, or it's a lead indicator in global markets. How should one view? Should we see dollar and then try to gauge what's going to happen in markets, or it is other way around?
It's a very good point that you raise. I think that the weak dollar has been very supportive. In fact, the dollar peaked on the 3rd of January last year. So the 3rd of January 2017 was the dollar's peak. It's been coming down for 13 months with only one brief interruption to that trend. And I think we're going to see emerging markets going to not underperform unless and until, and forgive the double negative there, but unless and until we get the dollar index back above where it started the year. Now, the dollar index today is 88.9. It started the year at 92. So we're around 2.25% weaker for the dollar. So I would say that the emerging market as an asset class is going to be okay as long as the dollar holds below where it started this year. Now, there's still some way to go. The dollar only had a very small bounce on Friday. This morning in Europe, it is unchanged. We're here at 88.9. I would say the big level to watch for the dollar is around 92. Because if we were to see year-to-date gains for the US dollar, then investors will begin to question one of the foundation stones for the EM equity rally. So as long as the dollar is below 92, EM, I don't think is going to come to too much harm relative to the developed markets.
Well, Nick, that exactly I was looking for, that what would happen to dollar index. Thanks for answering that question. One last question, Nick, before we thank you for joining us, is, a lot of participants over here in emerging markets are giving reasons for this major correction in US, and because of which corrections are happening elsewhere, is that Fed is going to hike the interest rates, and that's the reason probably markets are worried. But this fact we are knowing since quite few months, in fact, few quarters. So what exactly is the strong reason for this market to correct, and what is your opinion on a hike in interest rates going forward?
I think very good questions. I think the Fed will hike twice in the first half of this year, and we'll then see the extent to which equity markets have been able to withstand those two hikes. So I don't think we can say for sure that they're going to go 4 times, because it itself that is contingent upon the asset market reaction. But why was it that only on Friday did we finally begin to fall? I think there was a growing sense of unease around valuations, but there was what we might call the fear of missing out. And the fear of missing out on a rally was greater than the fear of a correction, because as long as the markets didn't correct, there was a belief that they therefore wouldn't correct. And I think what has been most important now is the psychological impact of investors realizing that markets can go down as well as up. So the fear of missing out was what really drove equities to new highs, even as people felt that valuations were stretched, that there was that higher interest rates were going to be a challenge. As long as the markets were going up, those concerns could be shrugged off. Now that we have seen that markets can indeed fall, and for many people, this is a shock, that now we have seen that markets can fall, I think we are going to see a changed investor psychology, and it is going to be a somewhat more defensive attitude going forwards. And I'm tempted to ask, and perhaps I could just leave this as a parting thought for you. You remember, it's only 5 weeks ago that investors thought that cryptocurrencies could never decline. Why were investors buying Bitcoin at 14,000, 15,000, 16,000, 17,000? Was because it had never fallen. Well, here we are now with Bitcoin at 7,000, and nobody wants to buy it because their attitude is determined by the price action. And what is going to be very important for global equities now is whether this change in sentiment, this change in investor psychology, is itself going to be a bit of a cap on prices from here. And my own suspicion is that, yes, that is going to be the case.
All right, Nick, thanks a lot for giving us your perspective on what is happening across the globe, especially in the UK and the United States, what's leading to this massive sell-off in the markets. And thanks a lot again for taking time out to chat with us.